Good morning and welcome to Taxes Made Easy. We've got a lot of news to cover like always, but we're going to try to really slow down and focus on the topic of the day, which today we're going to be talking again about assets. So we talked about housing assets the other day and how the IRS treats condos, investments, other kinds of property. And we're going to really stop and focus on vehicles and how to strategize when dealing with the IRS. When what do you do with the car? How do you prepare to negotiate with the car? And we're also going to be talking about other financial instruments. So 401ks, IRAs, Roth IRAs. How do you approach that and how do you prepare to save those assets when dealing with the IRS? So again, I just sat down with someone yesterday and we were strategizing how do we save their retirement when they have this IRS debt looming in front of them. So give us a call or stay tuned and we'll be right back after this break. Welcome back, everybody, and we're just going to dive in here. We've got a lot of interesting news. First one, I'm going to take a couple things that are a little bit off the beaten path. This one is from the Epic Times here. If I can get the computer to work. So we have crewed SpaceX mission. So this is an interesting story. If you haven't been following it, now they're kicking the teeth to Boeing that they've had. They had a flight that was supposed to go and pick up these people. They were only supposed to be 2 astronauts on the space station. They were only supposed to be there a week. Because the Boeing or government shuttle is having issues, and again, Boeing in general is having plenty of issues, the government for the first time is relying on a private shuttle to go up and pick them up. Now, this is going to be this. I don't think this is the actual shuttle. It's being launched on August 26th, different mission. But that private shuttle isn't going up there till February of 25. So instead of being there a week, these astronauts will be up there for 5 months. But SpaceX Falcon 9 is a private human spaceflight mission, and it's going to have a 4-person crew, 2 of which are going to do the first spacewalk by someone that wasn't put up there by the government. So spacewalks are common on the International Space Station to check the space station, make sure everything's fine. But they're going to do a 20-minute spacewalk. And the interesting part of this is that they're going to be using new slimline spacesuits during the spacewalk. And one of them that's going up is a billionaire, Jared Isaacman. Apparently, he's put $100 million into this to be able to go walk in space. It's his dream, and he's fueling flight exploration. And the other 3 people are retired U.S. Air Force Lieutenant Colonel and 2 senior engineers at the company. And I think it's a little bit interesting to see space exploration taking off. And it's interesting to see that private space exploration is succeeding where the government through Boeing isn't. So I don't know if the government's more to blame or Boeing, but it is cause for concern. But again, I growing up in the space age, I think it's neat to get back out there to explore and to push the boundaries. And there's a concern that private companies are doing it. I don't know. That's something for another discussion. So jumping to this next tab, actually some good economic news, which we love. July's national sales of newly constructed homes are up by more than 10%. So housing prices are up nationally. Interest rates or mortgage rates are finally creeping down, even though the Fed rate has not cut. Everybody's expecting them to cut it. So the mortgage rates, while influenced by the Fed, are not exactly tied to them. So Mortgage rates have been dropping somewhat. They're down in the high sixes right now, depending on your credit, down from around 8%, which was the high. But in this view of Phoenix suburbs in Queen Creek, Arizona, an increase by 10.6% in July. So these are for new single-family homes, which means builders are building. They're trying to get homes out there. They're trying to make a profit and build as quickly as they can. And so this is good news for the economy. Median price of homes sold was still $429,800, while the average sale price was $514,800. So they're expensive, but because of that, people are buying homes. And this is good news. We want to see this. We want to see home building. We want to see people buying homes, adding more inventory, and addressing some of the oversupply, the demand that's sitting. I want to say oversupply, but that confuses supply and demand. So we don't have enough supply of houses, but this is starting to address this. And this is not just in places like Phoenix, New York City. They're building condos like never before. They're seeing families and individuals move into even luxury market, where the average sale price in Manhattan was $1.2 million. But again, the more housing that is built to accommodate the supply, the lower the overall price will go. So doesn't matter where in the country, it's a good thing. So one of the things it mentions here, I just want to get to this last fact, is that median price in the Northwest, existing sales went up across the country, but went down in the Southeast. So that's the only concern here, is that in the Southeast, the sales went down a little bit more. But want to move on. Some good news. Want to point out some bright news when it happens. And let's jump to some other news. And from California again. So we talked about this bill to give loan programs to illegal immigrants. So essentially what this is, this is a controversial legislation. Passed the California Senate and passed the Assembly before. The Republicans are outnumbered 2-1 here. So it's going to be sent to Gavin Newsom's desk to be signed. It probably will be signed. And basically what this does, allows them to secure up to $150,000 or 20% of the home's purchase price. There's zero down payment on the state loan. So basically this provides a down payment just for people that are here illegally to purchase a home. And they don't have to pay on the loan. They don't have to pay interest on the loan until the home sells. So this is not something that's available to veterans. It's not available to Americans, citizens. It's just available to people that are here illegally in the state. So again, it's only going to apply for future years. So it gets into the details of it. But this is something that people are going to start. If this spreads, who knows? But again, this is one of the huge magnets. If we want to address illegal immigration, this is the opposite way of doing this. This is how you attract people into homes by giving out millions and millions in government money for first-time purchasers. But you can't be a citizen. You have to be an illegal immigrant, which could be unconstitutional anyway. There'll be plenty of lawsuits about it. We'll see what happens. But I mentioned this before, and now it's going to get Governor Newsom's desk, and he probably will sign it. Next article. This is something I mentioned the other day, talking about Pavel Durov, who founded Telegram, which is, I think, like the 7th or 8th largest social media site in the world. So it's used a lot in Central Russia, Central Asia. So again, this is a very big site. He was arrested in Paris by the French, claiming that there's criminal activities allegedly conducted via Telegram, but he's insisted on keeping Telegram free from moderation, free from government control. And they're saying the app has been used for drug trafficking and distribution of child sex images, child porn. A lot of other people in this, here's the real question: is it free speech or government overreach? So again, this article from Woke Spy definitely is on the side of free speech, but Tucker Carlson, Elon Musk, other owners, the Rumble owner of Rumble, fled France before he got arrested. And the frustrating thing: do we want government officials to be able to track illicit activity, drug trafficking, and child porn and target crime? Absolutely. The problem is when you have the government forcing moderation, they're not just going after crimes. They want to target hate speech. They want to moderate and control what is actually being put out and allowed on these social networking groups. So again, this is a lot of people are questioning his arrest today may echo past clashes between his commitment to encrypted or private communication and government demands for data transparency. And one of the points here is that these things that they're accusing him of having on Telegram happens on pretty much every social media network out there. So it's out there. Are they going to arrest Facebook next? Well, the problem is Facebook is, and it came out, and Zuckerberg recently admitted this, that the Biden administration pressured Facebook to censor speech, especially around COVID-19. Had nothing to do with crimes. It had to do with criticizing the government. And Facebook and other, Twitter was very complicit before it was bought and transformed by Elon Musk. They were very complicit in government censorship. That is a huge problem, huge attack on free speech, and a huge concern for our society. So I'm up against a break, and we will be right back. Welcome back, everybody. Hubert Johnson here with Guardian Tax Law. So got a new article here and a new topic. Drug price controls, underperform, unworkable. And this is an article by Newsmax. So this has been a big push by the administration, by the Biden administration. Been very popular to go after price control on drugs. So the question is, has it been effective? Let's dig into it. Let's see. And so this is the idea of taking Medicare and using their clout as a huge purchaser of drug prices to say we are only going to pay so much for medication and take it or leave it. And since it's such a huge part of the overall market, they can force people to do that. So Medicare recently announced the end of its first round of negotiations over the prices of 10 prescription drugs. And they say negotiations in quotes because really it is the program told people what they were going to, they set the prices and it was a take it or leave it kind of thing. So according to the White House, it will save $6 billion in 2026, the first year the prices will be in effect, while reducing costs for seniors by $1.5 billion. And so this is the federal government putting this out and announcing, hey, we're saving so much money. But like most information from the government, they might be inflated. It might be off. So this article kind of breaks down how did they get to it. So first of all, they're claiming that assuming, which again, Sometimes you have to do that when you're doing studies or numbers, but the government tends to make assumptions that favor them. That every Part D beneficiary is enrolled in the standard benefit, but many have more generous coverage. So this 1.5 billion in savings is really fiction from the start. And the reason why people have more generous coverage and they pay extra for additional coverage is because the coverage, Medicare and Medicaid, and again, I help people all the time. It's very rare that people aren't paying for extra benefits, because what you typically get is very substandard. So you have to add on additional coverage, and it's worth it to get decent care from Medicare. So that's really, so they're pointing out that most people have more generous coverage, so the savings number is fiction, or it's wildly inflated. It's not accurate. And also comparing the negotiated prices to the full sticker price, so the undiscounted list price. So without discounts, without anything else that most consumers normally price. So if you go and you look at the recommended sticker price and you just go and pay full sticker price, that's essentially what the Biden administration is comparing it to. For the 10 drugs selected, there are plenty of rebates, which would be an average of $315. However, the price reduction from the federal government was $101. But the thing is, the federal government, again, is across the board. Not everybody qualifies for the rebate. Those that have plenty of money or great insurance, the insurance company will pay the higher amount. So that does mean more drugs, but for the people, in general, or that the drug companies will be getting more money in general, but from people that have either insurance, great insurance, or the people that can't afford it will be getting these rebates. This does mean less money to the drug companies overall. Is the federal government really saving people so much money? Not so much. The problem is when you do price cuts, when the government goes in and sets price controls, one of the big concerns here is that there's very slight improvement at the margins. And that's what price controls do. They're slight improvements, but then there's one of the most destructible things and manageable. And this is a concern that's been voiced time and time again. It's kneecapping the incentive for investors to fund research and develop the next generation of therapies. The United States has been leading, whereas other countries, UK, France, Germany, Canada, and most of the developed world, have imposed price controls, and their research and development has tanked. So again, in general, on average, it takes $2.5 billion to develop drugs. And take it through the end of a decade, more than a decade, to bring a drug candidate to the lab. And so by giving the government the power to dictate, not negotiate, so there's very little negotiating going on, and just telling, hey, this is the price, that's it. We're seeing the opposite effect already. So they're saying it could deny the world 139 new medicines in the next decade. Now, if all of them are like Viagra, I think we'll be okay without them. But if it's 139 new medicines that help cancer, that help people in many ways, great. I get so tired of all these commercials all the time for one medication or another. But is it for the government to slow down development and research? Is that really their place? I have my own opinions about popping pills, and does that really help us? But the concern is, since this was started in August 2022 and no benefits are going to be seen until 26, a lot of work on drug candidates has already been stopped. And then they don't think they can make money off of it. They think the price controls are going to make these uneconomical, where they can't make their money back. hands off. They've already stopped this. So again, it's yet to be seen what's going to happen long term. But if drug companies are already stopping research into new drugs, it's having the effect that the opposite effect of what we wanted to have happen here. So again, there are consequences to actions, and it's not always positive. So here's an interesting bit. When I talk about politics, but I try not to get political. So this is an interesting one where we talk about what are the different candidates supposed to do? What are they proposing? And the Harris campaign is going back and forth. We have a history of what Kamala Harris has supported as senator, as candidate for president, working with and being in charge of things in the Biden administration. Even though they're trying to say she wasn't the border czar, the Biden-Harris campaign or administration actually promoted her with that title. And so here's another thing. So EV mandates. This is one of their big pet projects, one of the big things here as far as the Green New Deal. They wanted to cut the number of vehicles by 50%. So this mandate was a huge thing. So they wanted to, by 2030, sell 50% of all vehicles as EVs, and by 2040 to sell only zero-emission vehicles. That was their goal. And Harris has been a huge proponent of putting EVs on the road. The problem is car companies have cut back on building them because they've been losing billions and billions of dollars, and the demand for EVs has gone down. Maybe it'll go up in the future. Who knows? But by mandating this, now that we're looking at election, now she's trying to flip and say, and say we're going to get rid of this mandate that she's been pushed from day one. I mean, it's an election season. So you're going to hear all kinds of things that don't make sense and make you go, And, again, there's another article that she's for border control now. And that's been in the news, whereas her actions as a VP say something different. So take it with a grain of salt for what it's worth. Changing gears a little bit, I want to focus on, this is a really good thing that people should do. So this is from IRS.gov. If you haven't looked at your taxes for 2024, you should. Why? Because the IRS has increased the penalty for underpaying your taxes up to 8%. They did that last November, and it's going to surprise people in 2024. So if you haven't thought of your current year taxes, are you paying enough? You should sit down with the CPA, and I'm sure most people, or a tax preparer, and I'm sure most people are like, I don't want to deal with these yahoos. I just got done doing my taxes. Do a checkup, end of year summer tax checkup. I wholeheartedly agree with this advice from the IRS. I've been telling people to do it at least quarterly if you're self-employed, if you're a gig worker, if you have a side hustle, any income not subject to withholding, or if you're not withholding enough, you want to go in and revisit things and make sure you're not going to owe for the end of the year. If everybody starts following this advice, I'd be out of a job in 5 to 10 years. But, there'll always be issues with the IRS. But again, this is to make sure you avoid these penalties, 8% penalties on top of everything else. Failure to pay timely, failure to file timely, ongoing interest, plus any other penalties that they smack you with. Check your numbers, check what's going on. And this is a very easy way, or now that you're not under pressure, this is the best time to go in. The federal tax system is a pay-as-you-go system. So people think that they only have to pay by April 15th. That is incorrect. Legally speaking, you're supposed to pay throughout the year. Problem is, the difference is that before the penalty was fairly minor. Now it's jumped quite a bit from 3% up to 8%. So people are going to get hit by this, and it's going to surprise us. So, avoid unaccepted bills. You can use a tax withholding estimator. And if things have changed, new job or other paid work, major income change, marriage, childbirth, new home purchase, talk to a tax preparer or a CPA and go through this withholding estimator. Don't just do it through irs.gov. It's too simple. But if you've had any major changes in your situation, perfect time to stop and go through this. So I'm gonna try to stop right here with the news. I think this was a good article, but we're gonna jump to the topic of the day. I'm gonna try to spend more time on the topics of the day moving forward. We're gonna talk about vehicles. So vehicles are one of the biggest assets that people have, and it matters a lot when you're looking at someone's financial information. So it matters for expenses, and it really matters for assets as well. So we're going to talk about the asset side first. First of all, does the IRS want your vehicles? No. They really don't. They don't want to seize your vehicles anymore. They want to seize any other kind of asset. And as a pain for them to seize vehicles, it is a headache. They don't want to do it. So they only seize vehicles, houses in very rare circumstances where you've blown the IRS off, you've ignored them, and I don't recommend doing that. There's no point to irritating the IRS. If you do get letters, procrastinating rarely solves anything. And especially if you don't get your act together moving forward, you're only creating more problems for yourself moving forward. So when the IRS looks at vehicles as assets, the way they do this is they look at a vehicle, and let's say the vehicle's worth $10,000. It's an older vehicle, it's been sitting there. They take an 80% valuation of any vehicle. So if the vehicle's worth $10,000, they're going to treat it as having an asset value of $8,000. Now, this is where it becomes very important. Who's actually on the tax return? So when you're filing an individual, we're going to first talk about a single guy. So a single guy, let's say he has an older paid car and he has a motorcycle. He has a motorcycle for fun, but then he has a commuter car that he uses day in, day out. Let's say the car's worth $10,000. He will get a credit on that. One credit for one vehicle of $3,450. So by the IRS numbers, that will leave him with, and doing some simple math, $4,550 in equity. So a $10,000 vehicle is worth just over $4,500. Now, if you're doing an installment agreement or a non-collectible status, they're going to leave that alone all day long. They're going to be like, okay, a few $1,000s, not going to worry about it. It's his main vehicle. Now let's talk about the motorcycle. If the motorcycle is only worth a few $1,000s, they'll leave it alone. I mean, we're not going to force him to sell a motorcycle for a couple $1,000s. We'll put him on a payment plan. We'll do something else. But let's say that motorcycle is worth $20,000 and it's paid for. How do we figure out the value of it? Well, we go through, we take 80% of it from $20,000 down to $16,000. So it's a bigger jump than, it's 80%. And then you don't get a discount because it's one person and you only get the discount for one vehicle. Now, can he choose to take the discount on the vehicle and leave his car alone and leave that equity at $8,000? Yes. But then they could look at it and say, well, you have two vehicles, one's for fun. And why do you need two vehicles if, let's say, he owed $10,000? He's not going to qualify for an offer they could say, look, why don't you sell one of these vehicles and just pay it off? Typically, they won't, especially if you're dealing with smaller numbers. They'll just say, hey, just do a payment plan. We're fine. But the more value you have, the more equity that you have in vehicles, the harder it gets to make that negotiation. So I had someone just the other day, 2 vehicles, both Volvos. He likes Volvos. One's a 2020, paid in full. Again, $16,000 in equity. And then he has a second one that's worth around $10,000, worth about $8,000, and he gets that $3,450 exemption, but he can only apply it to one vehicle. So right now we're putting him in a non-collectible status. We're just like, okay, we hope the IRS doesn't raise the issue. Anyway, he owes a lot more than $10,000. So again, the IRS, as long as it's reasonable, why do you have this second vehicle? It's a project car, it's not running, something. Having some kind of story or explanation about it helps tremendously when you're going for a non-collectible status or for an installment agreement. In an offer and compromise, it's a lot more strictly based on the numbers. If you have that kind of equity, they will include it in your offer, and it will increase how much you have to pay in an offer and compromise. So that's why if someone has older vehicles and they're adding, a bunch of older vehicles and they're adding $2,000-$3,000 each to the offer, it might make a lot of sense to get rid of some of those older vehicles that you're not using, they're sitting around, take that extra money, pay down an allowable expense, and nobody's really going to bat an eye at a few $1,000s here and there. And again, it depends on the situation. If you owe $5,000 and you sell a car for $3,000, but if you owe $50,000 and you sell a car for $3,000, nobody's really going to question that. And as long as you take that money, you can show that you use it for living expenses, you'll be fine. So we're coming up on another break, and then we're going to talk about multiple vehicles in a family and how that breaks down for the IRS and how that affects monthly expenses as well. So just hold on tight, and we'll be back right after this next break. Welcome back, everybody. Thank you for staying with us here at Taxes Made Easy. So we're focusing on vehicle costs, and we talked about what it looks like for one individual, how the IRS will treat assets. So they'll treat vehicle as an asset. So if you have a loan out against a vehicle, so we're going to change gears a little bit. Let's say someone has a vehicle with the loan out for $12,000, and we're going to take the example of the Volvo. It's worth $20,000. When you take the 80% valuation, that goes down to $16,000. If you use it as a primary vehicle and you take $3,450 off of that, that's going to leave equity of $12,550. But if you have a loan out against it for $13,000, all of a sudden there's no equity. So you can have a car that has positive equity. Because of these favorable rules, if you have any kind of loan out against it, you can get rid of the equity in the vehicle, or you can show that by their rules there's no equity in the vehicle, and then you're fine. So let's talk about a vehicle. Let's say it's only worth $5,000. So if you have a vehicle that's only worth $5,000, you take 80% valuation of that, then it's down to $4,000. And then you subtract $3,450, there's only $550 in equity. So this is actually a very good rule, and it's good that they have these exceptions in place. They've been around for quite a while, because it keeps the IRS from going after an older vehicle, or if a vehicle has a loan out against it, because people need a vehicle to function in most areas of the United States today. It is important. And one of the key things to remember is that it's only for one individual, you only get one deduction and also one allowance for a car payment. So we talk about car payments, we throw that in the mix. The IRS currently only allows so much for car payments, and this changes year by year based on the allowable amounts. So if you go to, and this is nationally, so if you go to pretty much anywhere, if you go to the IRS allowances and you have one vehicle, they allow up to $619 for a car payment. If you are paying more than $619, the IRS doesn't care. They look at this as a luxury vehicle, and they're just not going to give you credit for it. You can get a more expensive vehicle. You're just not going to get credit for more than that amount for monthly payment. Now, this counts for a lease as well. So you can have a lease. And if you have a leased vehicle, they don't treat it like there's any equity in it at all, because you have to either purchase the car, you have to make some kind of decision at the end of the lease. So if you have a lease, no equity, but you don't have any rights to the vehicle after the term of the lease. So it kind of balances out. Now, if we add another person in the mix, so let's say we have father and son. And let's say the son is 16, he's driving, he's got his own car. The exemption and the credit for a monthly payment will still only apply to one vehicle. So let's say you have a dad supporting his father. So let's say you have a 40-year-old father supporting his 60-year-old father, or a 60-year-old individual supporting his 60-year-old father that lives with him, and he has him on his tax return as a dependent. How many exemptions will the IRS give him? Just one. So if he has two vehicles and his dad is driving one of his vehicles, which isn't the case most of the time, but it happens, they will only give him exemption for one vehicle. Same with the teenager. So if you're not listed as primary and secondary on the tax return, so really you're looking for a married couple, you're only going to get exemption for one vehicle. Now, for a married couple, you will only get two exemptions. They don't care which car, they don't care which vehicle you pick. Someone has a work vehicle and then they have two other vehicles, one for a teenager. They'll give you two. They don't care which car. They're not going to go to someone's house and who's really driving which car. They're not going to investigate like that. But if you have two individuals that are primary and secondary on the tax return, then you'll get two vehicle exemptions. So you get the exemption of $3,450, and they'll give you credit. Well, they'll allow for car payments on two vehicles up to $619 per vehicle. So if one car has a payment of $800 and the other one only has a payment of $300, the total allowable amount is not going to be $1,100. You just don't add them together. You have to look at it per vehicle. So if you take the $619, the $800 car will max out at $619, and then you get the $300 payment added to it. So that's a total amount of $919, not the $1,100, which is the total cost. So again, you got to be very careful. That's not the total amount of the car payments. It's per vehicle up to $619. And then they have another allowable amount for gas and maintenance, and that's a different category. We're not going to get into that now. So again, when you have multiple, if you have primary, secondary, if you have more than two vehicles, they're still going to treat the other vehicles just the same. You'll take an 80% valuation of the vehicle. If it has a loan out against it with no equity in it, that's a perfect vehicle to not treat as a primary vehicle, because the $3,450 exemption doesn't mean anything. Or if you have a payment on it, you might want to treat it as a primary vehicle to get credit for that monthly payment up to $619. So you want to be a little strategic as you look at it, and which vehicles do you want to list first and second on your vehicles, because those are the ones that are going to get, the IRS is going to treat as your primary and secondary vehicle. So depending on how much equity is in those vehicles and which cars have car payments, that's going to be how they're treated. So when they talk about vehicles, is it just cars and trucks? Nope. It's anything registered with the DMV. Trailers, RVs, boats, quads, dirt bikes, Anything that you go and I joke around when I talk to people. I'm like, any yachts tucked away? And everybody always laughs. Of course not. No. I wish. But any kind of vehicle, anything registered with the DMV has to be included. I have people that, I have this old horse trailer sitting on my property. It's registered. They'll know about it, and you have to include it. Now, a lot of times if you're doing a non-collectible status and some people, or a hardship status, and someone has a bunch of junk cars lying around, nobody cares, especially if they're worth a few thousand each. Just if they're non-operable, you can list those for a lot less, but you have to explain it. And we used to be able to list non-operable vehicles for $500, and most people would just ignore it. It's not worth anything. It costs too much to repair. The IRS is going to say now treats them as they have junk value, and they want a higher valuation for that. And that's a change in the last year or so. So just be careful of just treating vehicles as it has junk value. I'm going to put it as zero valuation or $100. The IRS is going to want more than that, and they're going to treat it as if it has more than that. Now, if you're just dealing with collections, doing an installment agreement or a non-collectible status, that's probably fine. Nobody's going to look that closely at it if they're older, or if you have a story behind it. I had one where it was a boat that needed a new motor. It needed a lot of repairs. I had someone that, they're like, oh, I love my car. It's great. I'll never get rid of it. I'm like, well, how much is it worth? Well, it's worth $5,000 to me. I'm like, well, how much if you were to resell it? Oh, well, it's been in a couple accidents, but it got repaired. If it's been in a couple accidents, even if it was repaired, when you go to resell that vehicle, it's going to take the value of that vehicle. And so if you have anything that's been in accidents, that has a salvage title, if it has dings, if it has engine trouble, those are the perfect things to list in your description of a vehicle to reduce the value. And if it's not working, missing an engine or needs a new transmission, and if you can say, look, the transmission, first of all, it encourages people to get rid of their junk vehicles if you have these projects that have been sitting around for years and years. Maybe it's time to do something about them. Now, like I said, if you're dealing with collections with an installment agreement or a non-collectible status, the IRS doesn't really care. But if you, and it depends on degree, if you have cars that are worth a lot more that are just sitting around, that's a different issue. But if you're doing an offer and compromise, they're going to want decent valuations on all of them, because they'll tell you, look, you can just sell the vehicles and pay us. So this is part of preparing for an offer and compromise, looking at your vehicles. Okay, where do I want to pay off some vehicles? Do I want to keep some vehicles? Which vehicles do I want to keep? Which will best help me with an offer and compromise? You want to sit down and strategize and think about what will help you the most. True story here. I had a gentleman who had a Corvette. It was in pieces, like completely apart in pieces. And in that status, how much was his Corvette worth? Not very much. I mean, he could have sold it for pieces. And he said, well, all I have to do is pay the mechanic. I just don't have the money to pay the mechanic. And he can put all the pieces together. And it'll be a functioning vehicle if everything works right. And if the parts, if. I said, well, if you put it together, then all of a sudden you're going to have this much equity in it. But if you have it in parts, I can sell it. I can tell the IRS that the equity is much lower because it's in pieces. It's a part. It's at the mechanics, the engine's out of it, etc. And it's a very different story. So we actually did an offer and compromise for him. That was not an issue. That the IRS accepted that. And afterwards, when he had the money, he can put it together, pay the mechanic, get the work done. But timing is everything. So I was talking to someone, was it yesterday? It was yesterday. And twice mentioned Jack Sparrow from Pirates of the Caribbean. Wait for the opportune moment. So it's all about looking at your vehicles. And if you have a vehicle with a lot of equity, Are you just stuck, or is there something you can do about it? You can always go and refinance your vehicle. Now, when I say refinance your vehicle, I'm not saying go to one of these title loan companies that are rapacious and really charge people insane amounts of interest and penalties. What I'm suggesting is sending them, you can go to a credit union or your bank, someone you have a relationship with, and I recommend credit unions. They always have the best rates for refinancing vehicles, and you can get a loan on it. Not only does it get rid of the equity by taking a loan out, but it also creates a monthly payment. Now, you only want to do this when you can afford to make these payments, but there are ways to prepare your case for an offer compromise that the IRS is not going to question. Now, if you get a loan out for $10,000, you got to show them, okay, what did you do with this money? If it's just sitting in a bank account, they'll just treat it as cash. But if you use it to pay down medical bills, if you use it to get some treatment that you've been putting off, I've had people go and get dental work that they've been putting off. If someone needed a surgery that they've been holding off, if you use it for normal, expected, reasonable expenses. Now, if you go get teeth whitening, no. If you go to get cosmetic surgery, no, they're not going to allow that. But I have had people that went and got dental implants that needed dental implants. So if there's been a healthcare or something that you need that you've been putting off, this is a good time to take care of yourself and set up your situation for success. And if you're taking out a $10,000 loan but using that to wipe out a $100,000 loan, it can make all the sense to do something like that. So when you're talking to someone about preparing to submit an offer and compromise, they should go through the numbers with you. They should go through the analysis with you. And then they should discuss, okay, how can we strategize? How can we help you here? Now, I don't do anything that I'm not 100% upfront with the IRS about. I'll tell them, hey, this is what we did. It's following your rules and helping someone qualify for a better offer. But again, we didn't do anything illegal. We're not hiding anything. If someone's suggesting that you hide stuff or assets, run the other way. They're going to get you in huge trouble. But on the other hand, I sit down with people all the time and I said, well, here are your options. I talked about the installment agreement, a hardship if they qualify, or the offer and compromise. And sometimes you could qualify, but you'd have to jump through so many hoops. It's like, do you really want to do all of that? And some people say, well, yes, I want to. Other people say, no, that's just too much. I don't want to do that. I'm like, okay, that's your choice. So you want to be reasonable about it. And if you're stretching too far, if someone's trying to stretch everything to make you fit, just like Cinderella's slipper, if you're trying to shove that foot too hard in that shoe, it's probably not going to work. So be reasonable in what you're asking the IRS to consider, but you can consider working within their rules to save you thousands of dollars and wipe out your taxes and give you that peace of mind. So consider that. Consider being creative where it makes sense within their rules. And so if you ever want a free consultation on how does this work for me in my situation, give us a call, 520-485-7371, or you can always look this and other episodes at guardiantaxlaw.com. So we're about out of time, and we're going to be talking about financial instruments next and how that can help you.